NetEase's Q2 2026 earnings just delivered this massive split result. I mean, we've got a top-line revenue beat, but a really significant EPS miss here. Revenue hit $4.4 billion, a roughly 30.11 billion RMB.
Which is up about 7.9% year over year.
Yeah, exactly. Up 7.9%, beating the $4.33 billion consensus. But then, adjusted EPS came in at $12.02, missing the $15.54 consensus by over 22%.
Ouch, over 22% is rough for any tech stock.
Right. And management provided no formal near-term numerical guidance either. They opted instead for these qualitative goals around global rollouts and AI integration. So naturally, the market reaction was brutal. Shares gapped down, falling somewhere between 4.5% and 5.8% as the market heavily penalized that profit miss.
Yeah, it was bloodbath.
So today, we are doing a deep dive into the earnings transcripts to figure out why this happened. It's basically like a bakery selling out of bread every day in record margins, but Wall Street is penalizing them because the owner made a bad trade in their personal brokerage account.
That is honestly the perfect way to look at it, because to understand how a company operating at peak efficiency suddenly loses a fifth of its expected earnings, you have to look at those non-operating headwinds. I mean, core gaming revenue actually grew 10% year over year.
Right, so the core business is fine.
Better than fine, actually. Operationally, they hit record gross margins. We are talking 70.5% overall and an incredible 76.1% just for gaming. That margin expansion was driven directly by lower platform revenue sharing costs.
So they are keeping way more of the money they make.
Exactly. But NetEase isn't just a game developer. They are an investor, so they hold stakes in other companies. And when the value of those outside investments tanks, which shows up as an impairment provision, it drags down their overall net profit on paper.
Even if the core gaming business is just minting cash.
Right, exactly. Combine those severe investment valuation write-downs with an effective tax rate that spiked to 25.5%, and, well, the bottom line just evaporates.
Okay, let's unpack this for a second. If the core gaming machine is printing money at a 76% margin, are retail investors sweating the wrong thing here? Like, hyper-focusing on these paper investment losses seems short-sighted when the real capital drain is escalating R&D costs. They hit 4.6 billion RMB this quarter alone.
Yeah, that R&D number is huge. And what's fascinating is where that 4.6 billion is actually going. Management strategy is heavily weighted toward global expansion and, of course, AI.
Right, the two most expensive things you can do.
Pretty much, yeah. Building the next generation of games to compete globally is incredibly expensive, and execution is proving really difficult for them right now. Like, look at their recent launch, Sea of Remnants.
Oh, right, the new open-world ocean fantasy game. I mean, it faced intense backlash right out of the gate in China for having an incredibly steep learning curve. The team had to completely scramble to optimize it.
Which just proves that launching successful new IP is incredibly difficult. Because Sea of Remnants stumbled, NetEase remains heavily reliant on their aging evergreen titles.
Like Fantasy Westward Journey and Eggy Party.
Exactly. They need those older games to fund these global ambitions. So upcoming titles like Ananta really need to land perfectly to justify this massive R&D spend.
And here's where it gets really interesting to me, because management keeps throwing around this phrase, development amplifier, to justify that spend. I have to push back here. Is this just executive buzzword bingo? I mean, are they just slapping the AI label on this to distract retail investors from runaway development costs?
Well, it's a fair question, but they are actually deploying proprietary AI models, like their Confucius 4 model. They use it to automate game asset creation and lower inference costs.
Okay, so there is actual tech behind it.
Yeah, theoretically, it reduces the need for massive art teams and speeds up production. But, until we see those tools consistently produce hit games faster and cheaper, the market is going to remain pretty skeptical.
Oh, absolutely.
The proof of AI's actual return on investment has to show up in future operating margins, not just in earnings transcripts.
So what does this all mean for you as an investor? Well, here's what you need to ask yourself today. NetEase is sitting on a $24.7 billion war chest of net cash, right? And they just generated $1.5 billion in operating cash flow this quarter alone.
Yeah, it's massive. And if you connect this to the bigger picture, you really have to wonder if the algorithms and institutional sellers are just so blinded by a one-time paper loss that they are handing you a discount on one of the most efficient gaming engines in the world.
I mean, it's definitely something to chew on. We will leave that for you to decide. That is all for this deep dive. Make sure to follow the show for your daily earnings coverage, and we will catch you next time.